Hey guys, it's Dave Keller here with Market Misbehavior. Today I'm going to share with you Dow Theory for Beginners. So Dow Theory is named after Charles Dow. He was an editor of Barron's and Wall Street Journal, and he wrote a series of essays and articles in the late 1800s, early 1900s, really creating the foundation of what we now know as Dow Theory, which is basically measuring the strength in the economy, or really the strength in the market, by analyzing different indexes and looking for the trends in those indexes to confirm one another. Today I'll share with you Charles Dow's original methodology using the Dow Industrials and the Dow Transports, a new Dow Theory using the S&P and the Nasdaq Composite, and what I would posit as a new Dow Theory. But let's start at the beginning here. Before we get to the charts, by the way, if you like the sort of thinking about technical analysis, market history, and investor psychology, why don't you subscribe to my channel? Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below. Next 10% move in the S&P 500, do you see as positive or negative? Next 10% move up or down, and why? Drop a comment, let me know. Now here we're looking at the chart of really an adaptation or a modernization of the original Dow Theory. It's really adapting it as close as possible to Charles Dow's original work. Now, when Dow created his methodology in the early 1900s, he used the Dow Industrials and the Dow Railroads, and it was literally looking at two pillars of the economy. The Dow Industrials were, representing the producers of goods. The Dow Transports representing the distributors of goods. So if both the producers and the distributors were all doing well, that meant economic conditions were pretty good. If both the producers and distributors were going down, if the Dow Transports and Industrials were going down, that indicated that the market or the economy was in a confirmed negative position. If one would break out and the other would not, then we would have a non-confirmation. I'll get to those signals here in a minute. Here we're looking at the Dow Industrials in the top half and the Dow Transports in the bottom half. You can see we're looking at these two indexes over the last 2 years, and the horizontal lines basically indicate what we are trying to do. We're looking for when these indexes confirm one another. So a bullish confirmation is something we just got here in the month of July, which is both the Dow Industrials and the Dow Transports broke out. Now, why is that meaningful? As I mentioned, it's because the producers and the distributors are all doing well, and so the idea is things are good. Where you get into trouble is if the Dow Industrials would make a new high and the Dow Transports would not, or the opposite, if the Industrials would not make a new high or fail to make a new high when the Dow Transports did. The reason why that's important is because it's called a non-confirmation. Basically, there's an issue underneath the hood. It may not be as obvious in the fact that the market conditions are still pretty robust, particularly one of those indexes is making a new high at that point, but the fact that they're not confirming one another tells you there might be an issue that is not as obvious as you might think. Here's the problem. In 2023, what are actually the members of the Dow? Well, it's things like banks and other things that aren't really industrial companies. It used to be the big conglomerates, things like General Electric types of stocks or similar types of names. Now there's, in a service-oriented economy, a lot of those traditional industrials are not as meaningful. So the Dow 30, the Dow Industrial Average, has adapted to reflect a modern economy. On the other side, the Dow Transports really aren't just the producers of goods. There are things like airlines, which do some cargo shipping, of course, but it's not really the main essence of their business. And some of the biggest distributors, things like Amazon or Walmart, which actually have a distribution system maybe built into their own business model, they aren't reflected in the transport. So it's become less and less of a reflection of what Charles Dow was really trying to get at, which was really trying to identify when the economy was functioning well and when it was not. So what can we do? There's a new Dow Theory which I like to use, which looks at the S&P 500 and the Nasdaq Composite. So same chart, but in the top half I'm looking at the S&P 500, the bottom half I'm looking at the Nasdaq Composite. What's interesting here is if you look back in May into early June, you saw again a bullish confirmation, a confirmed bullish signal when both of these indexes actually made a new swing high. It's interesting, you actually had the first Dow Theory buy signal back here in early February when both the S&P and the Nasdaq made it above their highs from the end of November, early December, for that Thanksgiving period. They made a new high, pulled back, and then both of them once again confirmed. So as long as these indexes keep confirming one another, conditions are good. So what are we looking for in this particular type of environment where the S&P 500 keeps making higher highs and higher lows, and the Nasdaq Composite is still making higher highs and higher lows as well? You're looking for this pattern, just like the Dow Theory, the Dow Industrials and Transports had a bearish non-confirmation the fourth quarter of 2021. You see the same thing from what I call the new Dow Theory. The S&P 500 made a new high from November of 21 into January of 2022. But if you look, the Nasdaq Composite actually made a lower high. That divergence, with one making a new high and the other one not confirming it, is called a bearish non-confirmation. That usually happens at the end of a move, and it indicates exhaustion, an exhaustion point in that bull market phase. You can have a bullish non-confirmation if and when one of the indexes makes a new low and the other one does not make a new low. We really haven't seen that a ton, although technically you could call this a bullish non-confirmation where the S&P made a much higher low in December while the Nasdaq Composite was making a new low. It really just barely undercut it, and on an intraday basis it didn't quite, but that's technically probably a pretty decent bullish non-confirmation as well. So you'll note from the chart on the right, we have not yet seen any sort of non-confirmation. According to this chart, the new Dow Theory, the S&P is making new highs and the Nasdaq Composite's making new highs. So why am I still going on? Why do I have another chart to show you? Because here's the problem. In 2023, we have a huge top-heavy issue with our growth-oriented benchmarks. Stocks like Apple and Amazon and Microsoft and Nvidia and Netflix and Meta are such big mega cap names. They dominate the Nasdaq Composite and they dominate the S&P 500. So those sort of 10 stocks at the top of the list are about the same weight as the bottom 400 stocks in the S&P 500. So there's such a concentration in the largest mega cap names that honestly, both the S&P and the Nasdaq Composite are really reflecting the performance of those mega cap growth stocks. So what can we do? I'm going to suggest a new Dow Theory. This is still a work in progress, but I think it has some potential here. How do we adapt for the fact or accommodate the fact that in those benchmarks, they're very top heavy, meaning the largest companies have an outsized weight? Why don't we equal weight them? The good news is in 2023, we have equal weighted indexes and equal weighted ETFs that are derived from those indexes. So even if you can't find the S&P equal weight index on a platform that you're using or the Nasdaq 100 equal weight index, we can do ETFs that model those. RSP is an equal weight S&P 500 ETF, and QQQE is an equal weighted Nasdaq 100 ETF. So we can look at the two of these and see how they're performing one another. You can see that the equal weighted Nasdaq 100 actually made a new high at the end of May, just like the Nasdaq Composite, just like the S&P. But note how the equal weighted S&P still testing the February peak. I would argue here in July of 2023, this is the chart I think may be the most important of the three that I've shown you. This may be the most important to watch because we're right at that point where the equal weighted S&P is testing resistance. It hasn't really followed through on a break above the February 2023 high. If it does, and if going into the end of July, beginning of August, the equal weighted S&P is able to break above the February 2023 high, that would be a bullish confirmed pattern, and the new Dow Theory would be a big thumbs up through strength going through the end of Q3 and into Q4. However, if the equal weighted S&P starts to fail here and the Nasdaq equal weighted Nasdaq continues to go higher, that would be a bearish non-confirmation and could indicate an exhaustion point in the raging bull market of 2023. That's Dow Theory for Beginners, starting with Charles Dow's original work with the Dow Industrials and Railroads, showing how we can apply those to the current market, adapt that with a new Dow Theory using the S&P and the Nasdaq Composite, and a potential new Dow Theory using equal weighted ETFs as a better measure of the overall strength of the stocks that comprise those indexes. What do you think? Thumbs up or thumbs down? Next 10% move in the S&P, higher or lower, and why? Drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well and take care.